Welcome to your weekly dose of educational, unbiased, and unapologetic business and tax talk. It's time for Nailed It, the construction and real estate finances podcast. Let's hammer out financial opportunities and pitfalls with your hosts, Jeremy Bollinger and Ian Grove.
All right, welcome back. First episode, Jeremy Bollinger, Ian Grove. Today we're going to talk about a general topic. It's how to pick your advisor. And that could be a financial advisor, that could be a CPA, that could be an attorney. Anyone that provides some type of professional advice needs to be done in an appropriate manner and carefully. And it's no one size fits all in this type of scenario. So those are the categories. I think if I missed anything, I'm sure there's like subcategories of, you're a CPA, but then you're a subcategory of CPA where you specialize in a certain discipline of accounting. So why don't you drill into the type of advisors that, you want to caution people on, and then I can talk about the ones that I want to talk smack about.
Yeah. I think I'll slander my profession first, the CPAs. I'm sure this is with every profession out there. You will get people that will claim to know more than what they know. So this goes back to the intro episode. Try and do some due diligence on your behalf and come ready to ask some questions of a CPA. So if I'm interviewing a CPA and I'm a real estate person or a construction person, I might come with the following questions. So for real estate, I'm going to ask them, what do you know about the short-term rental loophole? What do you know about real estate professional status? What does material participation mean to you? What about passive activity losses? Those are just some that I've seen returns just be blown up and clients lose under audit, because those are very, very basic tenets that you should understand if you're going to claim to be a CPA specializing in real estate. My background, I try and base my positions, whether it's something I'm doing personally in real estate or construction or guidance to clients, on Internal Revenue Code, IRC, Treasury regulations, or tax court cases, because tax court cases are kind of like the finger on the pulse. It's what's happening now. So if I read a tax court case and taxpayer lost his real estate professional status because he claimed it took him 52 hours to change out a toilet, then I'm going to tell clients, look, you have to be realistic with your time. Education normally doesn't qualify. Now, some of these things I will disagree with when I'm reading a tax court case, and my thought process goes, well, they probably just had a moronic attorney, because as we start utilizing IT and AI, it's not AI technically, but as you start using all these programs, you're going to be able to leverage your time so that it does it all, and you can just rely on the material participation test that your hours represent substantially all of the hours to get something done. So I'm just saying that just because it's in black and white in the tax court case doesn't mean that if we apply it to your facts and circumstances, you'll have the same outcome. Now it's legal precedent, right? So you may have that uphill battle. And then two, do you want to be the person that potentially fights the IRS all the way up through the various different tax court levels? So that's for real estate. Construction, just asking them, what does WIP mean to you? What does completed contracts, unallocated indirect costs, overallocated indirect costs, overbillings, underbillings? All of those should be triggers that should indicate something to them. So Ian, you and I have talked about multiple times on how to decipher a financial statement for a construction client. And I'll look at the balance sheet, okay? I'm trying to compare underbillings to overbillings. And we'll talk about that on a future one. One is an asset, one's a liability. And those terms in and of itself should mean something to you. Like assets, cash for me, cash, investments, cars, house. And then liabilities, credit cards, student loans, if I had mortgages, any other loans, those are liabilities. And normally, when I put it that way, people understand assets are usually good, liabilities are normally bad, right?
That's what we've been told.
And then for construction, does that follow through? Are overbillings good? Are underbillings bad? Or vice versa? So that's kind of direct and specific to construction and real estate, but just in general, if you're working with a CPA and the first thing that comes out of his mouth is I can get your tax liability to zero, run the opposite direction. I think both you and I have seen enough instances where when that was the promise, the result was, again, I'm throwing out this term. I know it has a legal, what's the word I'm looking for? Legal definition. But in my opinion, it was tax fraud. Like we're not a difference of opinion between professionals, and I throw out that term loosely with this person. But if that is the goal, they're probably not doing it correctly. And then on the flip side, even if they are implementing strategies that can lower your taxes, I'm not going to try. My goal, even personally with my personal taxes, I'm not trying to get to zero, because as you have tax deductions, whether you're doing legal, ordinary, necessary business expenses, so this means that it was required for my business, or you're doing some accelerated depreciation tactics by doing bonus depreciation, specifically with a cost segregation study, and you're able to take those depreciation deductions, blah, blah, blah. I'm not going to try and whittle it down, because that depreciation saves me on my tax liability by whatever my tax bracket is. So let's say I do a cost segregation study that shoots off $1 million of bonus depreciation. If I'm in the 50% tax bracket between federal and state, that's going to lower my tax liability by $500,000. Now that's simple, right? Obviously, it's going to shoot me down between the tax brackets as I'm doing it. But if I then go from the 50% tax bracket down to a 22 or 15 or wherever, I'm not going to waste using another cost seg study on a property or trying to come up with other legal methods to incur additional expenses to get down to zero, because it's not efficient.
Well, and by that, I mean, I think it's important to drill down to say, look, you can theoretically go down to, or technically go down to paying zero taxes, but why would I take a good depreciable asset, say of $100,000, and waste $100,000 of depreciable asset on like a 12% tax bracket, where I could wait till next year when I'm probably in a 25% or higher tax bracket? All you're going to save if you accelerate $100,000, if you take $100,000 deduction against a 12% bracket, you're going to save $12,000. Why wouldn't you wait till you say $25,000? It's just freaking arithmetic. That's it.
Yep. And that's a good point. Triggers. If you're working with someone and their playbook is the exact same thing over and over again, hey, you need to do bonus depreciation. You need to buy some equipment, so you can do bonus depreciation, bonus out your key people, do a profit sharing, and there's no other insight into it, you're probably missing the boat. Like, the whole reason why our disclosure says don't take this and blindly apply it to you is facts and circumstances. I'm not going to do the same thing for me as I will for another client. I'm going to interpret and understand your tax life so that we can do what's best for you. I don't know if we touched on this in the intro, but I think we did. If you're looking at the transaction just to mitigate taxes, you're probably eroding wealth. And the example I'll give to someone is, okay, if your employees did well and you want to give them a bonus, by all means, give them a bonus. But if they didn't deserve it, and I'm not saying this employees, like if you're listening to this and you're like, fuck my boss, he listened to Jeremy and I didn't get a bonus. No, I'm not arguing that. If people deserve bonuses, and most people do because they worked hard and they met key metrics, definitely give it to them. But if you're trying to, as the owner, put money into a profit share and do a bonus and the employees didn't deserve it, you're just taking money out of your pocket and putting it into someone else's. Whereas you could do something like a cash balance plan. And for the people that does work for, you can structure it in a manner in which most of the money that's going into a cash balance plan is a defined benefit retirement account rather than a defined contribution. The differences are a defined benefit. I, as the employer, am taking on the risk. So I'm telling the employee that, all right, you're going to have $500,000 in the account when you retire. If you don't have $500,000 in the account, me as the employer, I have to make up that shortfall. Defined contribution. Me as the employer, I'm going to put in some money. You as the employee is going to put in some money if you do have a matching. And then, look, employee, hopefully you pick some winners and you're not just in a target fund. I'm not talking shit about target funds. No investment advisors get mad at me, but the risk is on you. So that, again, just another instance of going back to what I was talking about. Don't use the same playbook over and over and over for the same employees. Look, I'm trying to come up with different ones for each employee, or not employee, but each client based on what they're doing, what they can do.
Yeah, dude. And like, I've had people in my experience that, review a set of documents. Oh, all of these people need these defined benefit plans. And I, like, this is not financial advice, but where it really becomes a benefit to the business owner versus the employees, there's math and certain factors that go into, like, why are you doing it? What are you doing it for? Do you just need a tax deduction, like you said, or do you really want to create a benefit for your employees? Or maybe you just want to keep it for yourself. It's not for everyone. And then there's like deferred comp, and there's all kinds of different ways that you can use financial instruments to chip away at that too. While we're on topic of CPAs, I think it's warranted to bring this up. And I can just talk from personal experience here. You can have a tax preparer that isn't a CPA. So can you talk about like what are the categories of people that are legally allowed to file taxes? What's the difference between a CPA, an EA, just a whatever, someone that has a P10? What do you want to look for? When does it not make sense to pay for a CPA? Because I mean, if you're just a W-2 with one job and no deductions, I mean, would you pay $350, $400 an hour for a CPA? Like, can you walk them through some of that?
Yep. Yeah. Good question. So before we jump onto that one, the one I want to talk about, you mentioned depreciation when you're at 12% tax bracket or 15% tax bracket. So that kind of trigger that I'm just now thinking of is, it is widely believed that tax rates are too low. Regardless of what anyone wants to think, most people believe that tax rates are too low and they have to go up at some point in the future. So kind of to this point, why would I take bonus depreciation right now when I'm in the 10% tax bracket or 12%? Let's just do the normal and spread it out over 5 years if it's a vehicle. Same thing. If I'm thinking that tax rates are going up, which I think, then I may not want to accelerate a bunch of deductions in the current year. With that being said, time value of money, if I can push off paying taxes a year, especially when in a high inflationary period like we've been the past few, then I do that. Again, it just goes to the whole point. You got to look at everything. You can't just do the same thing over and over and over again. And although I think tax rates are going to go up, they may not. And if I were a good prognosticator, I wouldn't be on this podcast. I would have made a shit ton of money in options or stocks or whatever, and I'd be sitting on the beach drinking a Mai Tai, hanging loose, right?
Brah. Instead, we're doing podcast drinking beers.
Right. So to your question, so first things first, when picking an advisor, ask explicitly, what is your credentials? Are you a CPA? Are you an EA? Are you just a tax preparer? Because this is going to be controversial. It's kind of like going to see someone in the medical profession. I'm going to ask, are you a doctor? Are you a nurse practitioner? Are you a registered nurse? Or are you just a holistic healer? I'm not talking bad. There's no negative connotations about any of these. I'm asking these probing questions so that I can gauge the risk.
Obviously, a CPA is a certified public accountant. For people that have not heard of the term EA, walk them through that.
Yeah, CPA, you got to pass exams, 4 of them within a certain period of time. I know in Arizona, where I was formerly, I'm now in Asheville, North Carolina. I have to emphasize that because sometimes people hear me say Nashville, especially when I start talking too fast. Horrible Asheville accent right there. But in Arizona, they just changed it because there aren't enough accountant professionals entering into the profession, so they're trying to make it easier to become a CPA. Take that as you will. But in Arizona, it went from having to pass 4 exams in 18 months to 4 exams in 30 months.
Wait.
So they extended the period of time by a year.
18 to 30 months, 30?
30.
And is the schooling, and by the way, the schooling requirements are pretty hefty. Like, we're not talking as high as law school, but pretty dang close. I mean, what's the schooling requirements?
Yeah. So everyone that comes out now, they have a master's in accounting or master's in tax, because when I came out, I graduated ASU, Sun Devil 2012, and then master's 2013. I think, don't quote me on those numbers, but you had to have the extra 30 hours that came with the master's to get you to the 150 needed for the CPA exam.
Got it. So, all right. And then look, like there's a difference between an EA is an enrolled agent, right? And then a tax preparer is a tax preparer. And kind of in my opinion, sorry, in my experience, the enrolled agent and someone that took a course to file taxes, they're pretty similar. Maybe the enrolled agent has a little more experience because they're required to pass tests. But what's the difference between an accountant, which is a CPA, accountant, you went to accounting school, versus someone that passed the EA exams and can file taxes, or someone that just files taxes and has no accounting background?
Yeah. So I've only worked with 2 EAs in my career. One was knowledgeable. He was good on the tax side. That's because he spent additional time educating himself. But him on the accounting side, the debits and credits, he was horrible. We would have conversations and he would say something like, okay, so I'm going to debit this and credit this. And he was like, no, you got to do it this way. And then I follow up, I thought you said this. It's like, I did say that. Okay, so we want to increase accounts receivable because we're saying the client is going to collect more. It's like, yeah. Okay, so it's a debit and credit. So I'm just throwing it out there. EAs may have gone to accounting. They got their undergrad in accounting, may have gotten a master's of accounting. Most of the times, if you've done that, you're going to sit for the CPA exam. EA exam, I don't know what it entails, but it's not as strenuous as a CPA. The only other EA that I worked with, I wasn't impressed. He would not dig into anything, and his default, what is it, modus operandi, whatever that term is.
Something like that. Yeah.
It would be, all right, I'm just going to plug a number, prior year adjustment. And so why is that scary? So when I or any other knowledgeable accountant looks at your stuff, we're going to do what's called rolling retained earnings. That just means the end of one year becomes the beginning of the next year, so that I ensure your taxable income is correct. Now, in layman's terms, the other way I describe it is, if I look at my bank statement right now, and on January 31st, it says I had $10,000 in the bank. When I look at the February statement, it better say 10,000 as the beginning balance. If it says 12,000, I'm like, oh, yay, I got an extra $2,000. But I'm thinking, is that money actually mine, or did the bank screw something up? So I got to investigate it. And then the scary thing, I would be pissed. I think I had 10,000 and now I don't have 4,000 at the beginning balance. What happened to that other 6,000? And
Right.
that is essentially what rolling retained earnings is I'm taking the accumulation of all the years that have happened, and that's what retained earnings is. It's all the income summarized in one number. At one presentation I gave for a construction group, one guy asked me, but I don't have a bank account with $1.5 million in it. It's like, no. Okay, so retained earnings is this. Think of it quick and dirty. It's your net worth. So when you put together a personal balance sheet, I list out all my assets: cars, cash, motorcycle, gun, safe, whatever. And I list out all my liabilities: credit cards, home debt. And then the difference between those two numbers hopefully is a positive, because I'm putting the assets as a positive number. I'm doing the negative for the liabilities. And hopefully I have a positive number down there. And that's my net worth. That's essentially what equity is for business.
Yep.
And theoretically, if I were to convert all of my assets to cash and all of my liabilities to cash and pay them all off, then I would have that number. But again, in business, you never have that because you have inefficiencies winding down a business, where as soon as someone figures out that you're going out of business or trying to wind it down, they're not going to pay you. Like, fuck you, man, I'm not paying you. Or you're going to have all of your creditors immediately asking for money right now. So you can't get the discount by paying net 215.
Right.
So
dude, I like, just to put a bow on that, it sounds, the way you explain it, like ending balance in January, beginning balance in February. Obviously, we're talking about years with the tax return, but Is it that complicated to make that calculation and put the right number in the box, or is it just, or is it complicated, or is it just people being lazy when they don't do that?
So again, teaching staff and interns, I tell them that there's 4 ways that retained earnings isn't going to roll. And I know we're so big movie buff. Ian, I know you're a big movie buff. One of the movies I like a lot is My Python and the Holy Grail. And if anyone's seen that movie, they're going down a track, and then every now and then you have like these weird cut scenes. And towards the end of it, they just start going, get on with it, get on with it. So that's kind of what we are right now. So if you originally asked about CPA, EA, P10, or not P, tax preparer, so we'll come to that and why P10, but kind of going off on this tangent, retained earnings. Yes, screwing up retained earnings happens more often than you think. And there's 4 reasons why it usually happens. So the first, and I just go through these 4 because it's easy. And I know we're kind of getting in the weeds for you non-accountants out there, but it will help you kind of question your CPA or your EA if you have one. Hopefully it's a CPA, or just even your CFO, your bookkeeper, your accountant, whatever they call themselves. If retained earnings doesn't roll, it's potentially the first one that I tell clients, the staff to look for. They didn't close distributions or contributions from the previous year to the retained earnings account. So I should close the distributions I took out in 2023 to retained earnings, and now that tells me what my capital account is. The next easy one to look at is the client posted something directly to the retained earnings account. You think that this doesn't happen? I've seen it a handful of times, and it normally happens when the client is posting. They didn't set up a distribution account, so they posted distributions directly to there, or they're doing something weird. Like there's always caveat, they didn't know what they were doing.
They didn't know where to put something.
Yeah.
Yeah.
And 2, VP of Finance was her title, but she was trying to close out a period, and she was posting the net income for that period to retained earnings rather than doing that in Excel, like exporting it and doing it that way. So and I forgot the quick way to check. So for the first one, you didn't close contributions, distributions. Is if you look at your balance sheet and your distribution number is 400,000, and you normally take around 200,000 each year. So there's your tell. And then you also look, okay, I'm rolling retained earnings. The prior year tax return said that my retained earnings should have a balance of 1.5 million. I'm at 1.7. The prior year tax return said I took distributions of 200. Well, okay, there's my difference. It's off by 200. So that's the easy way to tell. Easy way to tell for rolling retained earnings when it's the second problem they posted directly to. They just ask the client for the GL detail. And then I'll finish this up. I'm kind of going way too in the weeds. Number 3, and this one's a little bit harder. The client did post prior year adjusting journal entries. And this one, you just take the prior year adjusting journal entries, and I teach the staff, all right, what is the net effect on income? So look at all the accounts. If it hit the balance sheet, then ignore that one and go to the one that's hitting an income statement account and just, all right, here I debited an expense that increased expense, so that would have lowered net income. That's how I think of it. Usually the quickest way to check on that one is look at fixed assets and an accumulated depreciation. Most clients, they don't dispose of a bunch of fixed assets. So if my accumulated depreciation last year was 1.7 and I come to this year and the beginning balance is 1.6, okay, what was my depreciation expense last year? Oh, it was about a 150. And then I look in there, the client also posted the net activity. That's the quick and dirty way I tell our staff to look at it.
Got it.
And then the last one is, this one's unique to QuickBooks. QuickBooks doesn't really allow you to close a period. So if I void an old check, it's not going to put that in the current year as other income. It voids it going back 3, 4, or 5 years. So
Got it.
Clients, or staff, just look, are you in QuickBooks Online? Okay. Did you void some checks? Yes. And now, I mean, I created a training video for our staff on this, but the real way to check, if you really want to, is ask the client for a new trial balance for the same period, right? We save our trial balances in engagement. You can look at them. You can quickly line them up. You can do a VLOOKUP and subtract minus, and it will tell you, okay, miscellaneous expenses decreased by $50,000, cash increased by $50,000. Hey, client, did you void a check? Yes. Boom. Okay. And we fix it.
All right, dude. So for me, the takeaway on this, and it kind of goes back to the overarching topic of this particular episode, is the how to pick a CPA, EA, or tax preparer. Like, when does it make a difference? And to me, the rolling retained earnings apparently is not such an easy thing to try to figure out if you don't know what you're looking for, and you should probably have some type of accounting background or training on how to do that. So if you own a business and you're filing a corporate return, and that could be a partnership, an S corp, a C corp, whatever, it's probably best that you have an advisor or a tax preparer that's a CPA, or someone with a heavy accounting background that knows how to pick through that stuff. And that would, if I own a business, that's probably the first words out of my mouth. You know how to roll retained earnings? If they're like, oh, well, we just kind of, we true it up at the end of each year, like, that's probably not a very good answer. You want someone that'll help you figure it out. So can an EA do it? Sounds like they can, but you got to make sure that they can. I think we call them tax practitioners, or somebody that's not a CPA or an EA. Can they do it? Possibly, but you got to find out, and you want to probably even check references at that point, because they don't have any governing bodies outside of, who governs a tax practitioner? The IRS with their P10 number, which is a number the IRS gives you to file taxes, but they better have help on your stuff. So if I have a business, I'm probably going to go to a CPA, and if you're not paying, you pay for what you get, right? So if you're looking for the bargain basement version of getting your taxes done, I wouldn't expect a high degree of quality versus pay for good advice, pay for a good advisor, pay for a good CPA, especially if you have a need for a specialty and it'll pay back dividends, versus someone screws you up. And here me and Jeremy are almost a year into fixing a bunch of problems that former practitioner, as you kind of mentioned, made. So, and that's my takeaway.
Yep. And I would just say one other way to answer your question. Like, if I'm a W-2 person, all I have is a W-2, I have some brokerage accounts and a mortgage, maybe some charitable deductions, you can do your own taxes on TurboTax. There's no point to paying me and truth bomb, but the people that work at some of those tax preparation services where you can walk in and have your taxes done in 15 minutes, those aren't professionals. Most of those people have been hired 2 weeks before. They went through a quick crash course and they're plugging in numbers. And again, based on the numbers of returns I've seen, more often than not, it's not good unless you're getting just the basic services.
Yeah. If you have a W-2, you're a kid or whatever, and a couple $100, they'll get you done. Or you're probably even better off just going to the self-service. And I think IRS even has a self-filing platform now. But all right, well, time, please. Let's wrap this one up. My big overarching takeaway is, how much are you paying your advisor? And that should be a proportionate example, or even just look at what you're paying for your advice, and look at the credentials of the person you're paying, look at their experience, and make sure you're asking the right questions, like Jeremy's saying. Because if you're not, and you're hung up over price, you're probably not getting the right advice. Wow, that rhymes.
Right.
Oh boy.
The other thing that I meant to say this too, you get what you pay for. If you're just looking for compliance service, someone to prepare a tax return, I don't want to do your taxes. There's no joy, there's no fun in that. But if you're looking for someone to help you improve the business, to help you kind of structure transactions to mitigate taxes when that makes sense, then yes, let's work together. But if you are just reaching out to your CPA, EA, tax preparer once a year, there's nothing that they can do. You've locked in. You've already done the transaction. Now I can only do what I'm allowed to under the Internal Revenue Code, Treasury Recs case law. I can't structure the transaction before it happens to do a 1031 exchange, UPREIT, deletory statutory trust, lazy man cost seg, lazy man 1031 exchange, all the different terms that we'll talk about. But
yeah, you're a historian at that point. It's already been done. It's history. You're just going to do the best with what you got, and it's again, that's no fun. And also, that's not the best way to leverage you. Like, you improve bottom lines. You don't just file taxes. So, all right, cool. Well, I mean, look, we went over for our first one, but it's our first one, and there's a lot to cover. And so, thanks everyone for hanging in there with us. Ian, Jeremy, word.